Well, investing is anything but black and white. I brought my colleague and friend Dave in this week to talk about the basics of bonds and why there's hope. What is a bond, and why do people use so many different words for what seemingly is the same thing?
It's the same. At the most basic level, think of a bond as a loan. If you buy a bond, it's effectively a loan for a government or a corporation with a promise for them to pay you back at some point with some interest rate on top of that.
And I think that's an important distinction because a lot of times we certainly talk about investments in general as investors, but it's an important distinction between fixed income and how to think about their risks and rewards vis-a-vis equities and stock. Principally, that debt, that dollar owed, creates a baseline. That coupon creates a baseline of expectations that are there, barring a default, a failure to pay you back, that exist within the fixed income universe that don't for stocks. We can use historic price to earnings multiples and reasonably try to forecast earnings. But again, it's a little bit more ethereal, a little bit more theoretical on the equity point, where for a fixed income, again, cheesy cliche aside, it's pretty black and white. They either paid you back or they didn't pay you back. We know Dave won the warnings, most notably August 4th, 2020, for those of you keeping track at home, that we wrote about and did in our commentary on the state of fixed income. But it's been a turbulent time over the last 3 years. Could you explain what's driven that turbulence, and in so doing, just what are the basics of how bonds operate?
Yeah, so real basic bond math. We put it on the board here for you so you can follow us. But what we've been experiencing pre-2020, since pretty much the 1980s when we saw Paul Volcker come into the Fed, we had this great moderation of interest rates, and the Fed was effectively lowering interest rates for quite some time, all the way up until 2007. There were bailouts, and then interest rates, we effectively went into that zero interest rate environment. But the basic math behind that and why bonds were ripping to the upside the whole time is if we think about bonds, basically you have price on one side, the value of how the marketplace is valuing that bond. And on the other side, we have coupon or yield, and this is what Tim was alluding to. And they operate, typically speaking, opposite of each other. So when we have a Federal Reserve that's lowering interest rates that we saw during that great moderation all the way out to 2007, it effectively increased the prices of the bonds along the way. But just like if any of you went to try to get a CD at a bank, you couldn't get an interest rate for that CD. We saw the coupon or the yield for those existing bonds to continue to drop and the new ones coming out. So mathematically speaking, typically in a normal interest rate environment, you utilize a bond, and we can get into this a little bit. You're buying a bond for the yield or the income that it's producing, not necessarily for the price appreciation. But we were in this weird world pre-2022 where you couldn't get any yield, but bond prices were going up. So they started to get expensive, right? And then what ended up happening is the Fed started to increase interest rates as we started to see inflation. Effectively, they've been increasing interest rates, and so we saw the opposite happen. So now you can go into the CD, you can go get a CD at a bank that pays a little bit of something, but now we can get high quality bonds in our portfolio that actually pay us yield or coupons. But what we've seen along the way is this adjustment period where as the teeter-totter on this side goes up and you're starting to get more income off of these bonds, the price of those bonds temporarily were reduced. That teeter-totter effect, a little bit scary. We see portfolio valuations go down a little bit on the bond side, but we're getting a lot more for holding those bonds that we weren't getting before.
So I think the key thing, moving on to point number 3, which is really what is volatility versus risk, and looking at where we're at today. Again, yields have come up, and so the headlines you've been reading, we've driven prices down. As we alluded to earlier, haven't been super interested in fixed income for a while. Now we're starting to get interested. But what we're getting into now is a bleed, perhaps a touch higher over the course of this year in yields, driving the price down a little bit lower. Again, the difference between a coupon and the yield is, what was the baseline? That baseline that we talked about earlier. Yields going up can push the price down temporarily, but at some point in time, if you bought at a good level, they owe you that buck back. So that's the real big takeaway I want to cover in this next section is, what is that return hope? Why should everybody's individual interests and needs aside, which you talk to an advisor like Dave and I to talk about, why are bonds, if they're bent right now, not broken from these current levels. So a quick juxtaposition. In 2020, you had core bonds trading at approximately a 10% premium, meaning if you had lent someone $1 for a while, you could have sold those for $1.10 approximately. Here you have a guaranteed reduction, because even if that price has gone up, to Dave's first point, that debt holder still only owes you $1. Today, fast forward to current levels, core bonds and ag, things are basically trading, if that original dollar owed, they're currently trading at about 90 cents, okay, with approximately a 4% coupon, all right?
So to reframe this is the income you're getting along the way. Right?
Correct, the income. So what we're trying to help people understand in terms of where that hope is, yeah, this teeter-tottering can make any of us nauseous. Yes, price and yield in the short term can go up or down, but barring a default, which for investment grade bonds, according to S&P Global Intelligence over the last 40 years, have averaged for 5-year duration, which is kind of what we're talking about, the length of maturity left within the bonds, has averaged less than 1%, right around 80 basis points is the historic default rate. So if we're able to buy things at a 10-cent discount, assuming we might lose a penny out of defaults, not only should we be able to collect that coupon, but we should get 9 to 10 cents healing back up. So if you ever went to Google and saw what's the yield to maturity, or what is the real difference between yield and a coupon is the actual monthly interest payment. The yield factors into account both what is the coupon and what is the premium or the discount that you're paying to buy that bond. What is really going to be effectively the true return barring a default within that fixed income. This, I think, is critical for people to understand. It's why we wanted to bring back what is a bond, what's been happening with those bonds, and again, what is the hope for bonds, which is when you're buying high quality things at discounts with reasonable coupons, there is a very fair expectation that whatever volatility fluctuation you experience in the short term, there can be nice returns for those who are patient enough to hold on into the longer term. We hope this has been of help. If you want to reach out to either one of us on this or any other questions on your portfolios, be happy to chat anytime. Thanks so much.